Hi, welcome to the, let's see, is this February already? Wow, transaction review and calculator practice.
I don't, with Dmitry.
Hi, Dimitri. Nice to see you here. Sometimes the sound quality goes bad, so I have to mute everyone. Do you have any particular questions or comments right now of what's going on in your world?
No, this is my first webinar,
Okay, great.
so I don't have questions yet.
Great. Where are you from?
I am currently in Washington, D.C.
Washington, D.C. And what are you focused on? Buying notes, buying property?
I do own property. I am interested to learn buying notes.
Okay. So you're interested in adding paper or notes to your portfolio of rental properties?
Yes, correct.
Okay, fabulous. Ron, do you have any way of speaking?
Yes. Can you hear me?
Yeah. How are you, Ron?
Doing just fine.
You're out in Barstow,
Again,
right?
that's correct.
That's right. Good.
That's correct.
Anything in particular before I just get into today's example?
No, I'm just ready to jump in. Like Dimitri, this is my first webinar as well, so I'm just gonna follow your lead.
Okay, good. After we go through this, we'll probably have a little extra time. What I really like to use is sometimes the note deals that I'm doing, notes that I'm buying, but a lot of times my clients, the different consulting clients that I have bring up a lot of good opportunities. So this guy came to me. He wants to buy a $3 million Southern California property. And how come I did that? Okay. Oops. All right. So it's a Santa Monica Craftsman. Now, if you Ron, you would probably get this, but Santa Monica is a nice West Side area, very pricey, and
Yeah.
very close to the beach, and so, and it being a Craftsman is also amazing, and it was converted at some point into a 7 unit. I guess it was a pretty big house at one time, and one of the tenants hired me, so he's my client. He's got one of the 7 units, and he said this is really interesting. He works for a big bank,
Hmm.
and he had no idea how the whole owner carry thing worked, because the owner he had approached the owner with trying to buy it, but he didn't. And they had said that they would carry for him, and he had no idea about how that worked, not even the faintest clue. So it's really interesting that even people who work in the traditional banking world don't necessarily know anything about finance, so to
Uh,
speak, or anything about deal structure. Don't you find that kind of interesting?
Yeah, that's amazing.
yeah.
Yeah. In fact, though, I thought that he may not work in loans. I think he said he might be a forex trader for them, but still, he's in the climate, the whole time, and he finds, some weirdo named Note Queen on the internet to walk him through this thing, right? For $3 million. Anyway, it's been in the family since the late 1900s.
Hmm.
So you can see. And here's like an example of how much emotional equity that the seller has in it. So the owner's mother, now the owner is a very old lady. I think she's 82 or 92. I can't even remember. Something like that. But her mother, who lived in the property, died as a young woman, and the owner just really never knew her mother very long, just only knew her for her early years of her life. Anyways, her mother's spirit has been seen dancing in the yard by one of the tenants that's been in the house over 25 years. Who she's an artist. She's up at night, doing her paintings, and I guess she must be very intuitive or psychic or something. And she occasionally will see, when she described, what she saw. It's the mother recognized it as her, how she remembers her mother being. So, I mean, so whether that's true or not, the point is they don't want somebody to tear down this house, right? They have a lot of emotional equity, want it to stay the same, so that the spirits can dance where they want to dance. They don't want it to be torn down. Now, Los Angeles County has rent control. And, obviously, this means that, like, someone who's I guess that, let's take this one elderly lady. I think she's had it 25 years, I think in this wonderful location, I think she only pays $1,000 a month rent because you can only go up a certain amount every year or every whatever it is. And so market rents for something like that, if it was to be rented out new, I'm sure would be in the $3,000 to $4,000 range. So you can see that tenants are getting a really good deal, but in terms of cash flow and net operating income, you can see if you're looking at this as an investment, that's pretty tough when you can't raise rents to keep pace with inflation, or even market values. The current rents are at 85.50, and one of those units is empty right now. So if you add the 1,500 that it would probably rent for, that must be a studio, like a really tiny little thing. But so then maybe 10,000. Okay, so that's the situation so far. Okay, the tenant buyer has 500,000 down, and he was thinking he could buy this property hopefully for 2.5 million. He could put 20% down. Then the seller, well, not the seller, but the seller's son, who's managing it for his mother, had a real estate friend of him say, "Hey, what do you think the property's worth?" And to our chagrin, he said, "Oh, I think it's worth 3.5 to 4 million." But that buyer who comes in at that price is going to pay $100,000 to relocate all the rent control tenants, and they're going to have to tear down and rebuild the property to make it worth this sort of a price. And because then they can get market rents, right? They can get all new tenants in and eventually have much stronger cash flow. But of course, we know that the 82-year-old mother is not going to like this property to be torn down. But the son who's managing is tired of managing for his mother, so he just said, "Hey, look, try to get as close to $3 million as possible with a 25% down payment." And if you can do that, we'll carry the financing at better than the bank rates. So what are bank rates right now? What are they? Are they around 4, 3.5? Do you guys know? I can't keep track of it,
Yeah,
but
probably about 4.5,
somewhere.
3.5.
Yeah, so
Yeah,
something like that. I said we'll do better than the bank if you can get us our price on this down payment. And then the tenant's like, "No, all I got is my 500,000." He has a pretty good income. And he gets $100,000 plus bonus every year, but he can't. This is all he's got right now for the down payment, plus still to have money. There's some deferred maintenance. It's been an older building, right? So there's a lot of things that he'd like to do to upgrade it. So he needs to keep some reserves, obviously. He says, "No, the best I could do is like 2.75, and that's 18% down, my 500,000, and just because we're supposed to be practicing here." Hey, how come this is not working? Let me just move this over a little bit. So just so you guys know, this is the HP 10B2 by Day Development. This is the desktop version. If you don't already have the iPhone or iPad version, I would get it. I love it. I use it all the time. Clear all. Anyway, so just when I'm looking at this, okay, so he's got his $500,000 down, right, and divided by the purchase price, 2.7, what he's hoping the purchase price is. We can see that that's only 18% down, or you guys know about the decimal, right? The percents. Going back to math. All right, and then if he did that, then what would it leave, right? If he did a 2.750 minus his 500,000 down payment, then basically the note would be 2.25, right? So that would be our present value. And what if we stuck in 4% like the bank would do, and we amortized over 30? They might want a balloon, right? But we're just going to say have him ask for as long a term of financing as he can get. So that would make his principal and interest payment really, close to $11,000, and that's not even including taxes, insurance, and maintenance. But you can see that's kind of the reference point of maybe what the market would do if he could qualify for financing, although they might want more than 18% down, likely a bank, right? So on more like 30, I would guess, or 35% down. So anyway, but here's the thing. Right now, because this property is so old in the way that California works with Prop 13, the property taxes for this $3 million property, or 4 million depending, is only 2,000 a year. It's less than that's less than $200 a month, right? Because it's been there so long.
Yeah.
So if he actually took title to the property and got it in his own name at 2.7 or 3 million, they're minimum property taxes go up to 35,000 a year, more like maybe 40,000 with other probably add-ons that they have in that neighborhood. So can you see how that would ruin his cash flow so fast? If he takes title and property taxes go up by this much, like more than 10 times, the cash flow is just not going to work, right? So we need to figure out, number one, how can we work out this
Right.
deal, and also have him leverage the existing tax basis until he can apply for some historic thing and probably get, perpetual low taxes. But he would need time to do that. So that's kind of the strategy, and I'll talk about the different things we could do, but right now I want to jump to just working out what's his offer going to be. And it was really funny because it took us about 3 times, well, 2 times on the phone and maybe 2 or 3 follow-up emails for him to really get the difference between, well, what does it mean, owner carry? And he was like, I think you can only do that for 5 years, right? And I'm like, no. And wait, well, so what's the difference between, well, do I own the property or does he own the property? I mean, I don't own the property till the note's paid off, right? And I said, no. Owner financing is a traditional sale. It's, you would own the property, it would be in your name. It's just that the bank, there's no bank loan. The beneficiary on the note and deed of trust is the seller, the previous seller, instead of a bank. That's the only difference. And it was kind of interesting for him. He just, it's just really weird because when you think about it, like if he did get bank financing and buy the property, people just don't think, well, of course, then I own it. They don't go, oh, well, I won't own it until I pay my bank loan off. But when we get into the owner finance realm, sometimes people just don't have an idea of what that means. So anyhow, it was very interesting. But he's such a delightful guy, and he's so grateful and everything. It's really fun. But I want to jump over to how we let's see, where did I put that? Okay, so I pulled up. Do you guys know about T-Value? This is about $150 software program. It only works on a PC. But this is, if I'm trying to reverse engineer deals or work out amortization schedules, I always go into T-Value. And here, since I like a Mac, I have to have parallels on my desktop, which I don't really like this. It really bogs down my computer, but there are some financial programs that are only written for PC. Because I guess in the old days, Macs really didn't have the power of calculating complex things. So anyway, I really love this. So if you're going to get into it, besides the HP 10B2 calculator, I would recommend that you get T-Value. So anyway, so what I did is, here's our first example. Purchase price $275. I put in the Can you guys see this okay, or is that too small?
Yeah, it looks good.
You can see it? Okay.
Yeah, it looks good.
Yeah, it's
At
fine.
3%, right? That's even below bank financing. So they said they would carry below. And so let's see if they will. And right, so then here's the loan amount that I put in here. The loan, well, that was the date we started it, 2.25. And then we made, we just went in and I said, over here, we'll do 3% over 30 years, calculate for payment. That's not what we got. How did I do that? That's funny. He must have said that he wanted something where he wanted to keep his payment like at not too much more than the overall rent for the property, something like that, so that with taxes and insurance, he would still be, netting the same. But I'm not sure why. I wonder if I did this over 40-year am in the beginning. Yeah, that's what I did. A 40-year amortization. But of course, there would be a balloon due at some point, right? 44. No, that one's. Oh yeah, yeah. That was what we did. I said, okay, to keep the payment around 8,000 or 8,500, and I always told them go lower. Ask for really killer terms. They can always say no, but if you don't ask, you won't get it. So I said, why don't we ask for something that keeps your cash flow really good, and then we can have, a 30-year balloon, hopefully, because he said, well, they shouldn't have to carry for me for that long. And I said, well, you're going to want long-term financing. The last thing you want to do is to be in a crunch to have to refinance rather short term when we don't know what's going to happen with interest rates. Chances are they could be going up. So the longer you have on your term, the better. So like if in 30 years, 360 months, if I put that here in N, and then I solve for what will the balance be at that time, future value here, just click that, and you can see that it's a little bit different, and there's little differences in how these things compute, but you can see we're in the ballpark. We're in the ballpark there, right? 834,000. This is what it's calculated here. So if I go over to this tab and hit the amortization schedule that it spits out, now this is probably harder to see, but it just says here's the loan. There's 359 payments of 8,054, and then a big balloon payment 30 years from now, 842. And at each point, at every year, you can see principal and interest, and all of that. And one thing you can notice is that, that's quite a bit of principal reduction. Isn't that great? Because at first I was saying maybe you should just offer a straight, a lease option sort of a deal, and don't do a note like an amortization, but just say, hey, I'll pay you 8,000 a month, but I want you to put 2,000 of every payment towards my strike price, of paying down the value that I'm going to have to come up with. But then when we ran these amortizations, it's like, oh, he's already doing way better than that just to have them amortized like this. But it's not going to be written as a lease option, or the lease option. And I personally would pull in an attorney to pull this paperwork together, because it's a little strange. We're ultimately going to do a combination between the amortization of a note, except he's not going to take title in his own name. He's going to record an option to buy the property. But the lease agreement is going to have to reference this, although it won't be recorded anywhere. But so it's a little weird. So this is one of those cases where I'd go to Tyler, Hoppe, who's one of our members and who's very good at this stuff, understands all the creative stuff, and I'm going to say, hey, just make sure that this paperwork is all, clean and tight. But the idea is really great. So he goes, oh, okay, that's really, really awesome, right? He can buy this for 18% down, have it still cash flow, or at least carry itself without any more out of pocket than his improvements to the property. And, if he can get 30-year financing, all he's going to have to come up with, by then the property will be worth $5 million. All he's going to have to come up with is, or more, or less if it fell into the ocean, but, 842,000. So that should be very, very easy to find financing for it at that point, especially if he's still working for a big bank. So anyway, so that looked good, right? Not bad. And then he goes, well, let's just try to get what they're.
Yeah.
He's trying to say, how do I present the offer so I get this property? I really, really want it. I love it. I want to restore it. I'll keep it. I have no interest in tearing it down. So the family loves him because they think he'd be a really great caretaker. And I said, well, that's already in your favor right there. Plus, the son doesn't want to manage it anymore, so he's going to get his mom to offload it so he can quit having to manage this property. But I said, what could we do if we could try to get closer to what he wants, the $3 million? Because a lot of times, isn't it true, sellers are stuck on price, and they want their price, and sometimes they'll give even better terms. So, okay, what if we could pay the $3 million that they want to see, because that makes them feel all warm and fuzzy. But what if we ask for 2% financing? Hey, they said they would do better than the bank. That's better than the bank. And what if they'll take 22% down evenly spread over 4 years? And what does that do, right? Time value of money spreads out Yeah. So 3 million minus times 0.22 equals, okay, what if we pay, is that how what he came down with, 660 divided by 4 over 4 years? Well, it's pretty close. I must have been off somewhere on there. Oh, I guess he just said he would pay 600,000 down. Does that work? It's pretty close to 22% divided by 4. Nope. I can't. I don't know what I said. Oh, I know it's 650. Anyway, divided by 4. Sometimes I can't remember all the steps. Okay, that's what we came up. He said if I'll give them 650 down if they'll take it over 4 years. What does that do to, I mean, every year that he can wait by putting this money down is money that's sitting in his account, and, you know, really buying power, this fourth one you see down here that happens 4 years from now. No, is that 3? Yeah, 3 years from now. Really, the buying power of that is maybe 140. So if he can keep more money in his account, he has a slush fund for anything that comes up with the property. Plus, he can be growing that money. I told him, you know, in the meantime, if you don't have to put 500,000 out right now, and you don't need all that for maintenance, you know, you could be a private lender. And he goes, "What's that?" And I said, "Well, you could, even so conservatively, you could be putting your money to work at 7, 8, 9% uber safely in short-term real estate loans, so that by the time you need to come up with these yearly installments, you've already made, you know, $15,000, you know, that pays 2 months of
Right.
your monthly payment." And he goes, "Oh, well, you know, he just felt kind of nervous about that, but anyway, kind of funny." All right. So I'm going to take this 162. So if he would get 2% financing and be able to put his down payment over time, so minus 3 million. And now I'm going to use this to just change it to a positive number. So that would be his loan amount, right? 3 million with, right when we close, he puts a fourth of it down, 162.5. So then his loan balance is that. And if it's at 2%, and then, now you can see that I can't figure it out with this, right? Because this is an uneven cash flow. So you could see that if I put in 360, or we said 480, right? Amortized over 40 years. Let me make a 0 out of future value, because I don't want that to screw my numbers up. So we have this loan amount, interest rate here, amortized over there. Now we have a payment of 85.92. He can still live with this number. But you can see that, well, now what happens though, because that's why I have to switch to t-value to say, no, here's this, payment does this for this long, etc. So then when I switch over to here, so here's the loan amount, and then he's going to pay this for 12 months. And then at the end of 12 months, he's going to pay another 162.5, pay another year of 12 payments of this, and at the end of that time, pay another installment of the down payment. And so what do you think this does, not only for him, but for the seller? Number one, they want to preserve the property the way it is and have someone care for it and love it as much as they do. Number two, what do you think the old lady's worried about also? It's just basically cash flow, right? She needs her cash flow. Does this still give her cash to work with? This gives her, she's only getting 85.50 right now. But she also, out of that, has to pay for taxes and insurance and maintenance when it comes up, right? And I'm sure the son... Huh? Yeah.
Yeah, I have a question.
Is it risky?
How risky it is
Well,
for the seller?
the thing, that's why he's asking for 25% down,
Right.
because that would be a more standard down payment, so that if they did a traditional sale and he transferred title to this tenant buyer and just carried the note, then if he had to foreclose because he defaulted, he would be okay, because he knows that the guy, he's not going to lose money, because the guy would have put down, you know, 500,000, 600,000, and so even after foreclosure costs and all of that, he'd still get the property back, you know, and it's worth what, 3 to 4 million, and the loan amount would only be like 2 million or 2.2 or something like that. So it's the reason sellers Now, Dimitri, if you're thinking of carrying, most sellers for protection want the highest down payment that they can get because that's hard protective equity, so that if you have to foreclose even after legal fees and not getting any payments and maybe coming out of pocket for taxes and insurance during the meantime, that you're still going to have a good chance of protecting your principal. Does that make sense?
Yes, so I understand. We consider this transaction from point of
Yeah, this is
view
for
of
the
buyer,
this is
right?
for the
We
buyer,
wanted
really.
to,
Yeah, so I was thinking,
yeah,
if we
so
look
I
at
was
it
thinking
from
if we
point of
look
view
at
of
it
seller, right?
from point of view of
That's a
seller, right? Whether
good deal.
seller getting
And
a good deal,
I guess
and
main question is,
I guess one
what are
main
the
question
risks,
is
right? What is
what are the
foreclosure?
risks, right?
Yeah.
What is
So
foreclosure? So yeah, I understand that the loss, it's a cost of
Right.
foreclosure,
And
right?
plus, you will, let's say, if the person's not paying you their loan payment, then they're probably not paying taxes and insurance either. So you have to pick up those costs to keep it clean. So the loss is the cost of foreclosure, the fact that you're not receiving that money. You're going without the return on investment, and you have to come out of pocket for other things while you're foreclosing. But for this seller, so going back to the point of that, he doesn't want to take title, right? Because if he takes title, then the tax assessor is going to send him a nasty supplemental tax bill that will add $40,000 or $35,000 in costs to him. So he doesn't want to take title. So they're going to do a lease option, a rent to own kind of a thing, but they want to base it off a note. It's a weird hybrid, but that's what they want to do. And so now they're getting, even in this case, they're only getting 162.5, but they're staying on title. If this guy doesn't pay, they simply evict him. They
yeah,
evict
so
him. They have no
this option
foreclosure.
Yeah, so lease
simplifies
option
the process, right?
Yeah, it
simplifies
does
the
because
process,
title
right?
doesn't change, and so number one, there's no new tax assessment to ruin the cash flow of the property. And number two, the sellers don't have the risk of foreclosing on somebody because they will still own it. So if he doesn't honor his monthly lease payment or this payment that we're basing off an amortization, then he simply gets evicted. They tear up the option agreement, it's null and void, and they go on their merry way. They start collecting rents again. So there's very little risk to them, even if they took a very low initial down payment. But like I said, the guy's willing to come up in with 500,000, but I said 500,000 is a really high option payment. Most people that do a lease option, they only pay 3 to maybe max 10% of the value of the property. So even if he paid 10% of 3 million, he'd only be coming in with 300,000 for an option payment. Does that make sense?
Yeah.
It does. I have a quick question.
Yeah.
Yeah.
It does. I have a quick question. With the lease option, you have how long does the buyer have to
Yeah, he
exercise
he
that
was saying
option?
they only thought that they were allowed to give him 5 years, and I said, "Oh, you're gonna want to ask for a 30-year option
Okay.
because so it's whatever they will
Okay.
agree to." And normally people think of in terms of rather
Okay.
short term, but what's wrong with asking for a 30-year option that any time between now and the next 30 years I have the right to buy this property for $3 million? That gives him a lot of flexibility to
Hmm.
exercise when it's favorable, when loans are low. What if they spike up in the next at 5 years? What if they're double what they are now or triple? It's not been be a good time for him to have to go get bank financing, right? So he can wait and time it with, ultimately, how can he do better than 2%? So if he can get them to carry all the way, you can see that it's better for him. But if
Right.
they say, I just said, ask for a 30-year option and just try to get the longest financing that you can, because my client's the buyer. Now, if my client was the seller and they're going, how much is my note going to be worth? What do you think? What do you think this kind of financing does to the value of the note? These long terms and uber low payment. Let's see.
Yeah, probably big discount, right?
Yep. Let's put it in at 30. So At 30 years, the balloon, and I'm actually not able to put these other in, but this is just an example, right? So let's just say all he did is put the 162.5 and this loan amount, 360 of these, and at the end of 360, this balloon. Now, what if I want to come in as an investor? What do you guys want? If you're a note investor, what's the minimum yield you would want?
Maybe anywhere in the neighborhood of between, I don't know, 8 to 12%.
Okay, so let's put 12. Okay, and especially, you don't know what's happening with inflation, and this is a 30-year contract. What if inflation goes up to 15%? Your 12% is going to be better
Yeah,
than
just got
most
ate
people
up.
are making, but it's not going to keep pace with inflation. So I know people buying this long out that would, unless they have other reasons, go no less than 14%. Okay, plus, guess what? This is a really low down payment. Right? And
Yeah.
no seasoning. But anyway, those things aside, let's put in 14% here. That's the yield I want. Let's say I bought this the minute it was created, and I'm going to have the right to receive 360 of these, and at the end of 30 years this. So let's see now, what will I pay? What's the present value? Okay, I'll pay $739,000 for that 2.8 million loan. Isn't that astounding?
It
Yeah. So
is.
I was worrying for seller. Such a
Okay, but here's the deal.
low resale value.
They'd take
Yeah.
26%, maybe 30 cents on the dollar if they
Right.
had to liquidate today, right?
Right.
Just standard market without any other special interest. But the thing, what is she most worried about? Is she worried about the present value of her note?
She's worried about cash flow, money
She
coming
wants
in.
money coming in, but even more than that, what does she want? Someone who won't tear down the property, who won't kick the tenants out, that she has loved and nurtured this whole time, and who see her the ghost of her dancing mother. Okay, that's
That's
what
right. The sentimental value.
that's where the value is. The cash flow's great, but they also don't want the capital gains either. So they're not going to have to pay capital gains on any of this. So that's going to work good for them too, right? No capital
Yeah.
gains until he exercises his option. Now, I'm not a CPA or a tax attorney, so just take that with a grain of salt. And I told them they all have to figure out how this works for them. It's not my job to know that, just for them to be aware of it. So, look at this now. Do you guys remember the last one that we did, the 2.7 at 3%? Remember it started at like 22 or 2300 principal reduction? Look at how this jumps his principal reduction. The first month, 3800 goes through principal reduction. Can you see how much faster he's paying it down? And by the time he gets to the year 30, instead of a 800,000 or something balloon, he only has a $90,000 balloon. And he can afford this. The property carries itself at this, right? It carries itself. He's not going to have to, except for how he wants to fix it up and repair it and all that, right? So I showed him you should way just offer the 3 million at 2%, but we didn't know that until we crunched around on the numbers, right? So I said, so he goes, okay, well, just draw up one other one for me. And this is what he offered to them. 2.950 purchase price, 2% financing with basically a 22% down payment ish, divided over 4 years, and you can see that what it did there. And he made it just 85.50, so it was a number that it doesn't look like a weird number. This is the number they get every month, 85.50, 12 months. You guys see this, and then at the end, look, that drops down his final balloon payment, even a year in 29 years, basically. I think is that how that worked? Might be, yeah. I think this is less than a 30-year, and his balloon payment or something is 29,000. I don't know.
Yeah. It's interesting that their monthly payments would be about the same as they get at the moment.
Exactly, except they'll net higher because there's no taxes, insurance, or maintenance. And the son doesn't have to do this for his mother for free when he doesn't want to. And she'll still get the same. Plus, she'll have extra little bonuses every 4 years. She'll have an extra boost of 100 162,000. So if she wants to take the family for a vacation or get new hearing aids or something, she has the money to do it. No capital gains. I'm sure she has some income to pay, and they don't have an exposure to foreclosure. If he goes sideways, they stay on title to the property. So they have very little risk, and they feel good about this guy being a caretaker of their, sacred family treasure. So anyway, I thought this was an interesting one. It's a little different than my standard, consulting gig. I just love this stuff. It's so much fun. I just love working with people on their various things. So, I guess we're kind of out of time. Did that help, or is there anything with the calculator that we could go over again that didn't make sense the first time?
I just have a quick scenario I'd like to run by you.
Okay.
So let's say that, the mother, she loves the property. She loves the fact that the guy is going to take care of it and not and keep the tenants in place and not renovate or anything like that. And the son, he doesn't seem too partial to that. So let's say at some point the mother passes on.
Mm-hmm.
And so more than likely the son, he's going to be the owner of the lease options, the hybrid, right? The lease option slash note.
Right.
And he's saying to himself, well, I'd rather cash out early. So
He won't
how,
have he won't have the you can't change terms without the agreement of the other party. Like if
so,
yeah,
okay.
if I buy a property that has a
Hmm.
lease already on it, I have to honor the lease. Or an option, I have to honor the option. It's like taking it subject to the existing terms and contractual agreements that are already there. Or if I buy a note, I can't arbitrarily change the terms on the payer. That's already contractually agreed to. The only thing I could do is offer them a modification, and if they like it, if I say, if you can pay $200 more a month, I'll drop your interest rate, half a point or a point, and you can see how much sooner you'd own your property. And that will increase my yield quite a bit, but it'll be perceived by them as something good for them to do too. So,
Okay, so he wouldn't be able to sell that lease option?
he could at a huge discount. You can see that any investor, let's say they only needed a 8% return,
Hmm.
because they like the property and they have long-term goals for it. Let's see what they pay for that. It's not really a note, but it's kind of subject to the existing terms, right? They're still only going
Hmm.
to pay 1.25
Hmm.
for that property with
Hmm.
the existing terms there, because basically they only get the property if the guy doesn't exercise, defaults on his lease, his long-term lease, hopefully a 30-year lease. Who knows? They
Hmm.
might say, oh, you're going to have to do it, refinance out. Your option will only give you 10 years. They might say that, but we had him ask for the world, right?
Okay,
Because
right.
they can always say no. And he's my client. The seller's not my client. I'm not going to
Hmm.
do anything that's going to harm them, but they're actually getting a really good deal to sell to someone who's such a good guy and who will, honor their family tradition. And actually, the son really wants the house preserved too, and he doesn't want to manage it or own it. So he's actually pretty favorable. He's tired of managing it for his mom. He's a very
Okay.
busy professional, and he wants this guy to own it. So it's not like he's very amenable, um, to the situation. But no, because what we'll do is he'll record his option in the public record, so there's no way they couldn't like sell it out from under him or anything. With Otherwise, this guy can sue title all day long because he has a recorded option, and that would be a big legal mess for them to try to sell the property out from underneath him or anything like that. Plus, he has a long-term lease, right? He could record the lease. He could record. You can record anything you want, but he could record his long-term lease plus his option. Minimum, the option has to be recorded to protect him. But anyway, gosh, if I only needed 5%, can you see I'm only paying that's $1 million discount on the balance of that note, So
Hmm.
anyhow, he's the only buyer for this property and for his note. And probably if they needed money, they'd come to him and say, "Look, for 50 cents on the dollar, we'll take 50 cents on the dollar or 60 cents on the dollar if you just get us out now." Because you can see
Hmm.
that nobody else is going to pay him very much, right? He'll be the only one, and then he goes and gets bank financing. It's sooner than he wanted to, but he's getting maybe 40% off of the principal. So maybe he'll buy it for 1.8 instead of 3 mil. You see what I'm saying?
Mm-hmm.
But anyway, from their perspective, they're not thinking they're not getting a note that's worth anything on the secondary market or terms, but what they're getting is their price. They're getting emotional, safety, and they're getting effortless income that's better than they're already doing. And for the 82-year-old lady, that's all she really cares about, you know. And the son, he just doesn't want to manage it anymore. He wants this guy to own it, so all he has to do is deposit the check. So anyway, hope this was a little bit helpful. Any last minute questions before we sign off?
Where can we find the calculator?
Oh, in a day development. Let's see. For some reason, but yeah, if you look at
Parallel.
if you look at the links to resources, I think you'll find it there.
Okay, no
Oh
problem.
gosh, well this is boring. But anyway, thanks a lot for showing up. And look forward to helping you guys and working with you as we go along. So thanks so much. I appreciate it. You guys have a good weekend.
Okay, you too.
Alrighty.
Thanks,
All
Don.
right.
Thank you very much.
Bye bye.